All right, let's dive into something pretty special today. Warren Buffett's 1980 letter to Berkshire Hathaway shareholders.
You know, it might not sound like the most exciting thing in the world.
Shareholder letters, who reads those, right?
Right, but this one, let me tell you, this one is full of those classic Buffett insights.
Oh.
Pure gold.
Okay, so what's so different about this letter? Is it just me, or does Buffett kind of have a different take on earnings than everyone else?
He really does. He's not just fixated on the numbers themselves, you see. It's more about understanding the true potential of the businesses Berkshire invests in. He's looking at the long game.
So it's like not just what's on the surface, we got to dig deeper.
Exactly. Think of it like an iceberg, right?
Okay, an iceberg. I'm a listener.
So you're trying to figure out how much a company's really worth, but all you're looking at is their annual report. It's like trying to judge that whole iceberg by just the tip you can see above the water.
Okay, I'm starting to see where you're going with this. So the iceberg analogy, break it down for me.
Well, traditional accounting, it can be misleading. A company's reported earnings, that's just a small piece of the puzzle, especially when you have a company like Berkshire doing so many different things and owning all these other companies. It's those earnings, even if they're not directly on Berkshire's balance sheet, those really matter in the long run.
It's like he's looking at the whole iceberg, not just the tip. Fascinating. And get this, in 1980, the undistributed earnings from those companies Berkshire had a stake in, actually more than Berkshire's reported earnings for the year. Crazy reward.
It really highlights how differently Buffett views investing. He's playing the long game, focusing on the true value of a company and its potential to generate earnings over time.
It's about seeing the potential, not just the current picture. Okay, I'm with you. How does he actually put this into action, though?
Great question. Let's take a look at one of his classic investments, GEICO.
GEICO, huh? We're talking car insurance, right?
That's right.
Something tells me there's more to this than meets the eye, though.
You better believe it. This goes way beyond just selling insurance. For Buffett, this was about understanding the business from the ground up. He saw something special in GEICO, really exemplified his investment philosophy.
All right, lay it on me. What made GEICO so special?
Well, for one, they had this incredible competitive advantage, super low-cost operations. They were unbelievably efficient, which meant they could offer those low prices everyone's looking for, still make a profit.
So they're like the Walmart of car insurance or something?
Yes, exactly.
You don't get millions of customers without being competitive on price.
Right. But there's more to it than that. GEICO, they weren't just good at selling insurance. They were masters at allocating capital, knew how to use their profits wisely.
Okay, hold on. Allocating capital. Can we get a plain English version of that?
Of course. Simply put, it's about making smart decisions with your money, not letting it just sit there. And for GEICO, a big part of that was stock buybacks.
Wait, so they were buying back their own stock. What's the point of that?
It might seem counterintuitive, but this is where Buffett gets really excited. You see, GEICO was buying back those shares at a discount, less than they are actually worth. Buffett said it's like buying $1 for 50 cents. You're getting more for your money, increasing your ownership in a solid business, and getting a bargain at the same time.
That makes sense. Even if we're not all insurance moguls, what's the takeaway here for the average investor?
It's all about recognizing those core principles,
Yeah.
right? Look for businesses with a real lasting edge. Are they run by people who are both smart and care about their shareholders, about delivering value to the people who own a piece of their business?
Got it. It's not just about the product. It's about the business itself, the whole picture. This is fascinating stuff. But things were a little rocky back then, 1980. Inflation was a huge deal, wasn't it?
It really was. And Buffett, he doesn't shy away from that. He spends a large part of this letter breaking down why inflation is such a problem, especially for investors.
So how does inflation actually mess with your returns? It seems kind of vague.
Yeah, it's sneaky. I'll give you that. Basically, inflation, it eats away at what your money can actually buy over time, purchasing power.
Okay, I need a real-world example here because my brain's not connecting the dots.
All right, say last year you could get 10 gallons of gas, $40, right?
Right.
Now fast forward a year, inflation's at 10%. Those same 10 gallons going to cost you $44.
Ouch.
That's inflation for you.
So my money is literally buying me less, even if my investments are going up in value, at least on paper.
Exactly. Buffett uses this great example. Imagine you give up 10 hamburgers to buy into some investment, right? Time passes, you sell it. Even after you add in any dividends you got, you can only buy 8 hamburgers with what you made.
Man, now I want a burger, and I'm kind of questioning all my life choices.
Right.
But seriously, that's actually a really clear way to explain it. It's like this hidden tax eating away at your gains.
That's a great way to put it. And that's what makes inflation so dangerous. You have to factor it in to really see what your returns are. This isn't just Wall Street stuff either. This is for anyone who's trying to grow their money.
Okay, so we've got inflation going crazy in 1980. What else is on Buffett's mind?
Well, he's keeping a close eye on the insurance industry, and it's not looking good. He basically predicts this perfect storm, huge competition, bad underwriting, and to make matters worse, there's this accounting quirk almost no one is talking about.
Okay, accounting and insurance, not exactly my usual jam, but hey, it's Buffett. I'm all ears.
So interest rates, they're through the roof. Bond prices are plummeting.
Insurance companies, they love their bonds, all right.
Big time. So this is a huge GE deal for them.
Okay, I'm with you, but what's the quirk here? How does this all connect?
Here's the thing. Accounting rules back then, they let insurance companies keep recording their bonds at the original price they paid, not what those bonds were actually worth at that moment, even if it was way less.
Hold on, so it's like finding out your vintage, I don't know, baseball card collection is worthless, but you just pretend it's still valuable.
Exactly. And that created a really bad situation. These companies, they were terrified of showing those bond losses, so they started doing risky things, writing bad insurance policies, all just to prop up their assets, make it look like they were doing better than they were.
Wow, so they're doubling down on bad decisions just to avoid reality. That's not a great strategy.
That's putting it mildly.
Yeah.
Buffett saw right through it. He even says in the letter, and this is a great line, right behind having financial problems yourself, the next worst plight is to have a large group of competitors with financial problems that they can defer by a sell at any price policy.
Oof, yeah, it's like a race to the bottom. Nobody wins in that scenario.
Exactly. And that's why Buffett was so focused on Berkshire Hathaway's financial strength, even if it meant maybe missing out on some quick wins. He wanted to make sure Berkshire had the flexibility to weather whatever came their way.
Cash is king, as they say, especially when everyone else is panicking.
Couldn't agree more. Now, after all that talk about earnings, inflation, and industries imploding, Buffett wraps this letter up on a surprisingly personal note. He pays tribute to Gene Abegg, who sold his bank to Berkshire Hathaway years earlier.
It wasn't just a quick shout-out, though, was it? Buffett seemed to really respect this guy.
Oh, absolutely. He held him up as the gold standard of business partners. Abegg had integrity, a strong work ethic. He was totally transparent. Buffett talks about how Abegg was upfront about everything, even potential problems, before they even made the deal.
Wow, that's incredibly rare in the business world. Most people just want to make this sale.
I know, right? But it really says a lot about Buffett's own values. He'd rather partner with someone he trusts, someone who shares his values, even if it means maybe a slightly lower return, than play games with someone who's just out for themselves.
It's a good reminder that the human side of things, it really matters. In business, and honestly just in life, it's not always just about the numbers.
Perfectly said. And that's just a glimpse of what you'll find in Buffett's 1980 shareholder letter. We barely scratched the surface here. I highly encourage you to check it out yourself.
Absolutely. We'll be sure to include a link in the show notes. Thanks for joining us for this deep dive. Until next time.